Hello, I'm John Gillespie. Today I'm going to talk to you a little bit about the statement Wall Street hopes that you ignore, the cash flow statement, a forensics analyst guide to the cash flow statement. Right, 73% of all zombie companies show positive earnings before they collapse. That's why it's an important thing to pay attention to. Most analysts will use language, and they call it hedging language, to make you overlook the warning signs. So the earnings can lie, but cash can't. That's why we follow the cash here at Occam's Investing. Right. So on the income statement, revenues recognized when earned, not received. It's subject to management estimates of depreciation, reserves, and accruals. Those aren't absolutes. They can show a profit while the company burns cash. That's dangerous, right? Cash flow statements, on the other hand, they show cash received and paid in the real world. Hard to manipulate. Cash either moved or it didn't. Reveals the truth, and the income statement hides it. Right? So Occam's rule: if earnings are rising but free cash flow is falling, follow the cash, not the story. Just in my own personal life, I sold my company to a growing tech firm, and for a number of years, they were in this situation, and management was talking about EBITDA and all the rest of that, but they weren't earning a profit, and they came real close to not making it during the dot-com bust. They did make it, but was by the skin of their chinny chin, right? So then we have one statement, three investigations, right? So on section 1 of the cash flow statement, we have operating cash flow. The forensic question here is the core business actually generating cash? Section 2 is the investing cash flow. The forensic question here is the company investing for growth or survival? If companies are trying to grow and they're not profitable yet, that's the story that you're always going to hear. Well, it takes money to make money, so we're investing for growth. Right? Be careful. And then section 3, the financing cash flow. How is the company funding itself? Right? So here's the pro tip. The SEC forms, you search for the 10K for consolidated statements of cash flow. It's usually 1 or 2 pages. Operating cash flow, that's the heartbeat of the business. So OCF formula, operating cash flow formula, it's net income plus depreciation and amortization plus other non-cash items, plus or minus changes in working capital, equal operating cash flow. Here on Occam's Investing, you're never going to have to run that formula yourself, but it's good that you understand what goes into it, right? So that you'll understand when you get our investing alerts what a healthy signal, a yellow flag signal, and a red flag signal means, right? So if OCF is greater than net income, well, that's a healthy company. If OCF, or operating cash flow, is growing slower than revenue, that's a yellow flag. And if we have negative operating cash flow with positive net income, that's probably a zombie. The Damodaran principle, Professor Damodaran from NYU, start with EBIT, earnings before interest and taxes, not EBITDA, earnings before interest, taxes, and depreciation. Depreciation matters. It signals a real asset wear. So we don't want to act like it doesn't by pulling it out of the equation and investing in companies one way or the other. The working capital trap, where zombie companies first try to hide. And believe me, they do hide. Everyone figures they'll turn things around in next month or the month after. If you ever worked as a project manager, you always know when your project's running behind and you're telling your management, we'll catch up next month. Well, how often have you actually caught up? It doesn't happen very often in the real world. So the zombie signal, accounts receivables rising faster than revenue. Company books revenue, but customers aren't paying. Cash hasn't arrived, but earnings look great. Well, when they have the earnings calls, often analysts that are trying to be critical will want to understand how long days payments outstanding, or is that getting worse? I mean, was their accounts receivable being collected in 60 days or less, and now it's getting longer? Another zombie signal is inventory building up. Right, so the company's producing goods it can't sell. Cash went out the door, no cash came back. Right, so they're producing a lot of things, but they haven't actually sold them yet. And the yellow flag is accounts payable is growing, right? So if the days outstanding is growing, the accounts receivable is growing, and often companies will try to delay paying their suppliers so that they can collect the money on the other end. It's a short-term warning signal, right? Because what happens if companies don't pay or customers don't pay? Your suppliers eventually are going to want their money, and you're not going to stay in business long if you can't pay your suppliers. The pro move, divide operating cash flow by net income. A healthy company shows a ratio above 1. If it's falling year over year, you've found a potential zombie. Investing cash flow, growth, or desperation, which is it? Right, so they're often going to say, "Hey, we're investing because we have a lot of sales in front of us." NVIDIA has been a great one for that. They have, a lot of investment up front to get ready to produce those chips, and they've been selling them. But eventually, whether it's NVIDIA or AMD, they are going to go through the CapEx cycle, and then things are going to slow down, and they seem to slow down at a rate that people don't expect. So if we're building new factories and data centers and we're acquiring companies at fair value and R&D is capitalized as investment, OCF is greater than CapEx, we're free cash flow positive. It's probably good, right? A bad survival spending. Well, if our maintenance capital expending is being disguised as growth, acquisitions are slowing. We're acquiring companies, it's called roll-ups, and we're doing it to hide our slowing organic growth. And asset sales are propping up cash. Right? So if we have to sell factories or units of our business in order to stay in business, that is going to be something that will catch up with us in the near term. So these are things you want to pay attention to because it may not have shown up in the stock price yet. Financing cash flow. How a company funds itself reveals everything, right? So if they're self-funding, that's great, right? If they're making enough money so that they're able to pay for their growth out of their cash flow, that's called sustainable growth. But if they're issuing new stock and taking out lots of debt in order to grow, those are warning signals, right? Because at some point, the revenue is going to have to increase in order to support that, right? So here's the key question when you're looking at cash flow and the funding part. Is the company self-funding, right? Is cash flow covering everything? Or is it surviving on Wall Street's generosity, right? Or we having to issue new shares? The divergence signal, right? We issue, alerts when we come across these things, right? So when earnings say one thing and cash says another, trust the cash. So earnings versus cash flow, the Rivian example, right? So cash burn was going up year after year after year, and their net loss was going up faster than operating cash flow, though they were telling everyone that they were investing in growth, right? So the divergence formula, net income, over operating cash flow equals a divergence. A positive divergence equals earnings, and basically if it's greater than the cash generated, it is a zombie candidate. The death clock formula. We send out alerts via Slack. If you're a VIP subscriber, you'll probably get emails related to this if you own one of those stocks. Once you spot a negative free cash flow, here's how long the company has. We calculate what their current cash and equivalents are, divide that by their monthly burn rate, and tells you the months to zero. Now that can always change because they can raise cash, they can sell something, they can sell additional shares into the market. But at the going rate, this is when they will be out of business. And one thing that you can be sure of, most of the time the burn rates don't go down. Most of the time companies burn more cash the more desperate they get. This is how our AI monitors 10Ks and 10Qs. One number, unambiguous truth, right? Find any cash flow statement in 60 seconds, search.gov, right? So search out there and you want to search SEC.gov and you can look for Edgar and you can type in the ticker for a fast search and it'll give you the 10K filings. Open the 10K, the most recent 10K. You can usually be able to find it as an HTML document. You can search for statements of cash flows. Use Control F to land directly on the statement. It's usually 1 or 2 pages. Find the 3 key lines, right? Net cash from operating and invest divided by investing and finance activities. And then apply the Occam's test. Is operating cash flow positive? Is it growing? Is it exceeding capital expense? Those are the 3 questions that give you instant clarity. And SEC.gov is completely free, so you don't need Occam's Investing to be able to get this information. We just go through it quickly and make it so that you don't have to do any calculations, you don't have to do spreadsheets, and you don't have to even understand these things because we will digest it and we'll have AIs run through and give you an opinion on the health of the company based on the algorithms on our platform. So your 3-question cash flow forensic test. If it passes all 3, it's not a zombie. Is operating cash flow positive? So if OCF is greater than 0 and growing year over year, it's a good thing. If it's negative, it means the business is burning cash from operations. It's a zombie candidate. And the reason is the core business must generate cash. Everything else is noise. It depends how they're getting money. If it's not from the core business, it makes you have to go, what's going on here? Is free cash flow positive? So if operating cash flow is greater than capital expense, free cash flow should be positive or improving. If it's negative, it means that the company can't fund itself. Debt or equity issuance is required. Why? Free cash flow is what's left for the shareholders after keeping the business. So if you own the stock, this is why it's important to you. And is the death clock less than 24 months? Cash reserves divided by the monthly burn is the number of months of runway. You really want it to be more than 24 months. Anything under 24, especially under 18 months, is high risk. Under 12 months is existential. Even if a company is burning cash, runway tells you how much time is left to fix it, right? And it takes time to do an acquisition or to sell yourself or to sell shares. And you don't want to be in a company when it has to declare bankruptcy. Your shares will be fairly worthless. So what you know now, after going through this little cash flow mini course. So you should have a high-level understanding of why cash flow statements expose what the income statements hide, how to read all 3 sections of a cash flow statement, and the working capital signals that precede zombie companies, right? So what do you look for before a company becomes a zombie? And how do you calculate free cash flow and the death clock? And the 3-question forensic tests for any stock, right? So hopefully you're already in Occam's Investing, but if you're not, join it and you'll get all this information fed to you via Slack messages and emails. If